Hey, Danny.
Hey, Professor.
How's it going?
It's kind of chilly today.
Yeah, it's nice.
Yeah, it's nicer than the heat, though.
Yeah, for sure.
But Professor, I have a question.
Sure. What's up?
Uh, so I know that you taught us like incremental versus the individuals. I know
Yep.
the incremental usually just tells us the best option, regardless of whether you do the first two individual options.
Yep.
Would there be any case that you would want to do the individual ones?
Um, it's always good to check just to make sure that you're not being scammed. If you want to check the options individually just to make sure that they give you like a positive rate of return, or if they give you a benefit cost ratio greater than one, that's always good to check, because if you do the increment, hopefully the increment will tell you, which one's better. But it's always not a bad idea to check each one individually just to make sure that they're actual real things, or they're not scams.
Oh, okay. Thank you.
Hey Samson, how's it going? All right, it's 1 o'clock, so let's go ahead and get started. All right, good afternoon, everyone. How's everyone doing today?
All right.
Good, good. Yeah, all right is good. Better than bad.
Afternoon, Professor.
I'm good. I'm good. Thank you. I have something to show you guys. So actually, I was driving home on Tuesday, and I blew out my tire, and it looks pretty gnarly. And so I have a picture to kind of show you. I kind of wish it happened next week because okay, well that's not true. I wish it didn't happen at all. But next week we're going to be talking about replacement decisions in this class, and so it was a good lesson of you know, I should have replaced my tires sooner rather than later. Yeah. Pretty exhausted. Yeah, no, I know you guys are. This is always the time of the semester when you guys are going through so much, and you know, with midterms and everything, and you know, we still have a pandemic, so you know, I don't envy your guys' position at all. So so hang in there, guys. You know, it's it'll get better, I promise. Yeah. Okay. So I finished grading your midterms. Oh man, hope she's okay. Yeah, getting rear-ended is it's not fun. Yeah, check her, make sure her neck is okay. Yeah. So I finished grading your guys' midterms last night. I actually wasn't planning on grading last night, but I realized that as I was grading yesterday afternoon, I forgot to hide the grades. So people were already kind of seeing their grades happen in real time. And so I didn't want some of you have to wait until the next day to see your grade. And so I just finished them all last night. And so you guys did really well. And so the average on the exam was about a 44 out of 50. Okay. Right. And so if you log back onto the exam on Canvas, you should be able to see your score. And I've left feedback on every single, well, on every single question that I took off points. I gave a brief explanation about why I did that. Okay, and so make sure you check that out. Make sure you check it out sooner rather than later. And if you have any questions, or you know, if you want to discuss, or if you think you deserve more points, then you know, definitely let me know. And I'm always very open to discuss those things. Okay. But yeah, so the midterms are graded, and so I'm glad I was able to get that done. Because usually I like to finish grading a week after the exam, and so I kind of just barely got that in this week. So so yeah, check that out. Okay. All right. And so besides that, the plan for today is we're going to continue our discussion on taxes. And so we're going to be talking about the different ways you can compute depreciation. Okay. Because I think last time we kind of introduced the idea of depreciation and how you know it can affect your tax calculations. And so today we're going to do a lot of examples, and you know, we're going to see how you actually factor in depreciation and how do you compute things like an after-tax present worth. Okay. Okay. Any questions before we get started? All right. So actually, before we get started, let me show you what my tire looks like. It looks pretty gnarly. I've never seen my tire do this before, and so this was my tire after I ran over a curb, and so I think I was just a little bit sleepy, and I just wasn't really paying attention. And then you know, I kind of went over a curb. It honestly didn't sound like it was that bad. But then I started, you know, my car started doing like as I was driving, and I started to see smoke. And so I pulled into a neighborhood, and then I realized that, wow, my tire is it's not there anymore. So I called AAA, and I had them help me replace it. So I kind of had to endure the AAA guy kind of looking at me like, you fucking dumbass. But I knew that if I tried to explain it, it would just only make it worse. And so I just kind of like, I know I can feel his judgment, but you know, there's nothing I can do. And so, you know, and so I'm driving on a spare right now. And so if you see my car on the road, please don't hit me, because I don't have any more spare tires. And so I'm not going to get it replaced until tomorrow. Yeah. Okay. All right, so let's go back to engineering economics. All right. And so we're talking about, last time we were talking about depreciation and taxes. Okay. Okay. And actually, last time I forgot to talk about one important thing, which was state income taxes. Okay, and this is especially relevant for us in California because California has the highest state income tax out of any state in the U.S. Right? Because last time we kind of went over the basics of taxes of, how do you take your income, how do you deduct away, necessary expenditures, and then how do you compute taxes from that? But we only considered taxes from just one source, and so that was from the federal government. Okay, and so depending on what state you live in, the state can also tax your income as well. Okay. Okay. Because just like the federal government, the state government also has to needs funding in order to run, and so states leverage taxes in order to fund this. Okay, and so at first, when I looked at the list of state taxes, and you see California right at the top of of highest taxes. At first, I got upset. It's like, hey, I don't want the state of California taking that big of a cut on my paycheck. But then I realized that the state taxes also pay my salary, and so I'm like, okay, state taxes not so bad. All right, and so the state taxes are usually something separate from the federal ones. Okay. Okay. But the nice thing about the American tax system is that you don't have to pay taxes on both. Okay, and so what I mean by that is that the same income isn't subject to the same amount of taxes. Okay, and so the way it usually works, and the way it works for individuals is that when you get your paycheck, the first agency that takes a cut is the state. Right. Okay. And so, let's say that you made $100, right? Just as an example. And so let's say the state income tax was 10%. And so the state is going to take, 10% of that money. Okay. And so the nice thing is that, when the federal takes their portion for taxes, they don't take, the same amount that you took from the state. Okay. And so to kind of put this in another way, you can deduct the state income taxes from your federal taxes. Okay. Okay. And so this is kind of the way that that the American tax system basically lets you not get taxed on both. Okay. All right. And so let's do just a quick example just to kind of show you how this works. I think explaining in words I think is a little bit more difficult than just actually looking at it as an example. Okay. All right. And so let's say that a small design firm in Pennsylvania has a taxable income of $100,000. Okay. And so let's say that Pennsylvania has a state income tax of 10%. Okay. I guess this is going to be California too, because California is right up there as well. Okay. And then just like we have been for all the other problems, let's assume a federal tax rate of 21%. Okay. All right, and so in this problem, let's take this $100,000 and let's compute, how much this design firm is going to pay in taxes. Okay. All right, so first we're going to take the state's share, okay, and so that's going to be 10%, and then the federal is going to take just whatever's left after that. Okay. Okay. Any questions on this? Okay. All right. So let's go ahead and do this calculation really quick. All right, and so the state taxes is a 10%, and so we're just going to take 10% of our taxable income. Okay. Okay, and so we're going to take our $100,000 multiplied by 10%. Okay. And so this is $10,000. Okay. All right. And so now that you've paid taxes, you've paid that $10,000 to the state. Now you're not going to get taxed on that $10,000 again. And so before we compute the amount of taxes we paid towards the feds, we're going to subtract this $10,000 from our original taxable income. Okay. All right. So we have $100,000 minus the $10,000 that we just computed. Okay. And then we arrive at $90,000. And so the 21% that the feds are going to take from your income is not going to be based on the 100,000, but is instead going to be based on this 90,000. Okay. And so now let's compute the federal taxes. Okay. And so federal taxes is going to be 21% of this 90,000. Okay. And so this gives us a number of 18,900. Okay. Right. And so the total amount of taxes that we pay is just going to be the sum of these two. Okay. And so that's 28,900. Okay. Right. Right. And so if you're doing tax calculations, either for this class or for your own personal use, and you're paying both state and federal income taxes, make sure that you don't compute your federal taxes based off your original taxable income. Okay. And so you want to make sure that you subtract whatever you paid for in taxes, right? Make sure you expense that away, or you deduct that away from your federal taxable income before you compute your federal taxes. Okay. All right. Any questions on this? Okay. All right. And so that's state taxes. Okay. And so now let's go back to depreciation. Okay. All right. And so remember, depreciation is a way to represent how the value of a large capital purchase decreases with time. Okay. Because we talked about last time how engineering companies, a lot of times they're buying up, pieces of large machinery. So whether they be, big pumps or big pieces of production equipment. Okay. And so, because the company is using these machines for business, they want to deduct that cost away from their taxable income, right? Because, basically any amount of money that you spend running your business, the government says, we're not going to tax you on that because that's what actually contributes to the economy. Okay. But for a large capital purchase, this is usually one huge, purchase that happens up front. Okay. And the company is going to use this for several years, right? And so for tax purposes, we use depreciation as a way to figure out how much of that large purchase we can deduct from our taxes each year. Okay. Okay. All right, and so I think last time, the last thing that we drew in this class was kind of an example. Okay. Right, and so let's say that the y-axis on here is the current value, or another word to call is the book value. Okay, the book value of a piece of equipment. Okay, and on the x-axis here we have time. Okay. Right, and so when you first purchase a piece of equipment, then the cost is usually at its highest. Okay, and so this up here represents our initial cost. Okay, and then this is going to slowly decrease with time. Okay. And let's say that we decrease it over this many periods. And I don't know how many there were. I just drew dots. So let me count. Seven periods. Okay. And so over the 7 years, then the cost of this purchase is going to decrease over that amount. Okay. And so for tax purposes, right? Remember, whenever we compute our taxable income, we can subtract any cost that or any money that we spent on running the business. Okay. For a large capital purchase, the amount that we can actually deduct from our taxes is the difference in between successive book values, right? And so if we look at the value of our machine at the beginning of this year versus at the end, okay, this amount right here, this amount of that I kind of drew in red, this is the amount that we can deduct from our taxes. Okay. All right. Any questions on this? Okay. All right, and so there's four main methods for computing depreciation. Okay, and so what I'm showing you here in this graph is what's known as straight line depreciation. Okay, so I think that's probably the simplest one, and so that's the one that we can start with. And then there's going to be three other ones that we're going to introduce throughout the course of the lecture today. Okay, but I did want to start with straight line because it is the simplest one. And with straight line depreciation, we're going to do an example which kind of showcases how to perform these kinds of tax calculations. Okay. Okay, so let's go ahead and start with that. All right. And so straight line depreciation, the way that it gets its name is that it basically assumes that the book value or the current value of your asset will decrease linearly with time. Okay. Okay. Or another way to say this is that the asset is going to lose a fixed amount of value in every time period. Okay. And so the way that we compute this is that we have a very simple formula. Okay. Okay. And so this formula will help us compute the depreciation amount. Okay. All right. And so it'll be the value for this is going to be I minus S divided by N. Okay. Where I here, I is our initial cost. Right. S is our salvage value. Okay. And then N is the number of periods. Okay. All right. And so if you know the salvage value, and of course you probably know the initial cost and you know the number of periods, then you just plug it in here and that's the straight line value. Okay. All right. And so the way this works is that each year you're going to deduct this depreciation amount from your taxable income. Okay. Okay. And so by doing that, you're going to reduce the amount of taxes that you pay because your capital purchase reduced the capital purchase reduced its value by this amount, and then you can deduct that away from your taxable income. Okay. All right, and so with doing this, we kind of introduce a new class of problems, or maybe not a new class of problems, but it's a spin-off, the problems that we have been doing. Okay. Whereas we can now incorporate taxes into our cash flow conversions. Okay? Right, and so we're going to do an example of that on the next page. Okay. Okay. Any questions on this before we jump into an example?
What does that say before can in the last sentence?
We.
Oh, we. Okay, I thought it was do. Thank you.
Okay. All right, and so let's do a simple example. Okay, and so the it might look simple on paper, but it's but you'll see that incorporating taxes can be quite a lot of work. Okay. All right, and so let's say that you know, you work for a shipping company. Okay. Okay. And part of the company's model is that they kind of take packages, or they take you know, containers from the port, and then they ship them off to warehouses. Okay, and so so let's say that your company just recently purchased a new truck, a new shipping truck, right? Which had an initial cost of $50,000. Okay. All right, and so in terms of the amount of capacity it has, and how much it can drive, this truck is expected to produce $20,000 of revenue each year for 5 years. Okay. All right, and so at the end of 5 years, the company can salvage the truck, or they can sell the truck off for $10,000. Okay. All right, and so if we assume an interest rate of 10%, okay, and we assume a federal tax rate of 21%, okay, we'll ignore state taxes, and so we'll assume that we live in like Nevada or Texas or something where there's no state income taxes. Okay, and so if we assume these, let's compute the before tax and after tax present worth of the truck. Okay. And so and then we're going to use a straight line depreciation schedule for the truck. Because that's the only one that we know at the moment. All right. And so, we have a situation here, okay? And so first thing we'll highlight here is the initial cost of the truck, okay? All right, and so the truck costs $50,000, and so that's the initial cost, okay? Next, let's identify the income, okay? And so we have a gross income of $20,000, okay? The amount of time that we're going to use this truck is 5 years, and so that's going to be our N, okay? And then finally, we have a salvage value of $10,000, right? And then some of the other miscellaneous information that we need is we need to know the interest rate and the tax rate. Okay. All right, so let's start with the before tax present worth, because that's something that we know already. Okay, and so if we assume that we're not going to pay any taxes, let's compute the present worth of this truck. Okay. Okay, and so this will be our no tax present worth. Okay. All right, and so we've done this many times at this point, and so I'm just going to go pretty quickly. Right, so first we have our initial cost. So our initial cost is $50,000, so we have a minus 50,000. Okay, then we have our revenue, and so our revenue each year is $20,000, and so that's going to be positive. Okay, to convert it to a present worth, we need a P over A factor for 10% and 5. Okay, and then we also have our salvage value too. And so our salvage value in this case is $10,000. Okay. And then we're going to use P over F, 10% and 5. Okay. All right. And so if we look up those two conversion factors in the compound interest table, then what we get is $32,059. Okay. All right. And so that's the before tax present worth. And so, without accounting for taxes, that's the, we can say that investing in this truck is the same thing as getting a check for $32,059. All right. And so now let's work on the after tax calculations. Okay. And so for the after tax calculations, we're basically going to be taxed on this $20,000 that we make. Okay. But we're not going to get taxed on the entire 20,000 because we can reduce that taxable income by the depreciation. Okay. Okay. And so each year, that truck is going to be losing value, right? Because, it starts at a peak of 50,000 and each year it's going to be depreciated by a certain amount. Okay. And the amount that the truck depreciates, basically we're going to consider that as kind of the necessary expense or an essential expense for running our business. Okay. And so we can then subtract that depreciation amount from that 20,000 before we actually start to compute the taxes. Okay. And actually, before I go on to the next page, let's compute how much value the truck is going to lose each year, okay? Because remember, we're using a straight line method, okay? And so for a straight line method, the formula for computing the depreciation amount is the initial cost minus the salvage value divided by N, okay? And so in this case, the initial cost is $50,000, okay? The salvage value is $10,000. Okay. And our N here is 5. Okay. And so if we do the calculations, this means that their truck is going to lose $8,000 each year. Okay. All right, and so each year when we compute how much taxes that we owe, before we multiply that number by 21%, we're going to subtract away this $8,000 because that's, that was a cost of running our business. Okay, and so we shouldn't be taxed on that amount. Okay. All right, any questions on this before we actually start computing and stuff? Okay. All right, so let's go ahead and write down how our tax calculation is going to go. Okay, and so the way that I usually organize these tax calculations is that I do them in a table. For a straight line method like this, it might seem like it's not really necessary, but once we start getting into some of the more complicated tax rules or depreciation schedules, the table is really going to help. Okay. All right, and so the first column is for the year, okay? And so for each year, we're going to keep track of how much of our cost has depreciated, how much taxes that we're paying, and what's our after-tax cash flow for that year. Okay. All right, and so we have 5 years, and so I'm actually going to start the table at year 0, just so that it gives us that flexibility. Okay. Because year 0 is where we're going to put our initial cost. All right. All right, and so in the second column is going to represent our before tax cash flow, right? And so before we compute any taxes, this is the amount of money that we're either paying out or receiving. Okay. All right, and so let's go ahead and fill in this table, or fill in this column, right? And so in the first year, or in year 0, I should say, I'm sorry. And so at the present day, we have to purchase the truck, and so the truck's purchase was $50,000. Okay. And then each year after that, the truck is going to be earning income. Okay. And we know that the amount of income or the amount of revenue that the truck produces is $20,000 per year. Okay. And so that's going to be a positive $20,000. Okay. In year 5, we're still going to have that $20,000 that the truck is producing in revenue, but we're also going to add to that an additional $10,000, which is the salvage value of the car, right? Or the truck, I'm sorry. Okay. And so in that last year, we're going to have a before tax cash flow value of $30,000, which consists of $20,000 from the regular revenue and $10,000 from the salvage value. Okay. All right. And so our next column here is going to be depreciation. Okay. And so the depreciation represents how much value the truck is losing per year. Okay. And so in year 0, we just kind of put a dash mark here because we've literally just driven it off the lot, and we're going to assume that we didn't lose any money by doing that. Okay. All right. And so since we're using straight line depreciation, the depreciation amount is the same every year. Okay. And we just computed that number to be 8,000. Okay. Okay. And so each year our truck is losing that $8,000 worth of value, and then we can then deduct that from our taxable income. Right. It should be 8,000. Oh, sorry. Got ahead of myself. Thank you for that. Yep. And so the depreciation, yeah, should only be 8,000. Okay. And so after we computed the depreciation for each period, we can then compute our taxable income. Okay. And so the taxable income, remember the way that we compute that is we take our before tax cash flow, and then we just subtract any necessary expenditures as well as depreciation, okay? And so for this problem, we didn't list any cost of labor or materials or anything like that. And so the only deductions we're going to consider is just depreciation, okay? And so the taxable income in this case is going to be just 20,000 minus 8,000. And so this is going to be 12,000 each, okay? Okay. Oh, excuse me. All right, and so now that we have the taxable income, we can then compute how much taxes that we're going to pay each during each period. Okay. Again, for year 0, I'm going to put just a dash line because we haven't earned any money yet, and so we can't pay any taxes. Right. And so the way that we compute taxes is that we just take our taxable income, which was the previous column, and then we multiply that by 0.21. Okay. And so for this problem, oh sorry. The last one here should be 22,000 because we have 30,000 minus 8,000. Okay. And so for this problem, we take 21% of 12,000. We get 2,520. Okay. And then on the last year, because we have higher income there, okay, then the taxes that we pay is 4,620. Okay. And so remember how we got this column was the product of our taxable income multiplied by tax rate. Okay, where our tax rate in this case, remember, was 21%. All right, and then finally we can then compute our after-tax cash flow. Okay, and so after we paid our taxes, how much money are we left with for that year? Okay. All right, and so to get this column, the way that you compute it is you take your before tax cash flow and you subtract the taxes from it. Okay. All right. And so in the first year we have 17,480. Okay. And it's like that for the first 4 years. Okay. But in year 5, because we have the salvage value, we pay a little bit more in taxes. Okay, but we also earn more money that year. Okay, and so for that one, it's going to be 25,380. Okay. Right. And so in this column right here, the way we compute that is before tax okay, before tax cash flow minus taxes. Okay. All right, and so now that we have the table filled out, we can then use all of the columns here on the right to compute the after-tax present worth. Okay. And so the after-tax present worth, in this case, it's a fairly straightforward process here. Okay, because we have, if you look at the columns on this or this very last column here, you can see that we have our initial tax, our initial cost, which was $50,000. Okay, and so we have an minus 50,000. Okay. Okay. Plus 17,480. Okay. And since this is a uniform series, we can say P over A. Our interest rate is 10% and 5. Okay. plus, plus we're going to add the salvage value at the end. And so the salvage value is the basically the difference in between the last two, right? And so we're going to subtract 25,380. Okay, and we're going to subtract the usual uniform series, which is 17,480. Okay. Right, and so, it looks very similar to our last expression here. It's just that, the numbers are changing around because we had to subtract taxes, okay? And so if you compute this and you plug in the values from the compound interest table, what you get is an after-tax present worth of 21,171.91. Okay. Okay, and so you can see from this is way lower than it was before, right? And so before we took taxes into account, we had a before tax present worth of $32,000. And so after we've incorporated taxes, our present worth went down by about 10,000, right? And so now our present worth is 21,171.91. Okay. All right, and so that's a basic example of how you do or how you incorporate taxes into, let's say a standard present worth calculation. Okay. All right, question. So why did I do the 25,380 minus 17,480? Yeah, because that 17,480 that's coming from revenue from that the truck's producing, right? And so that last term at the end right there, this is meant to represent the salvage value. Right, because from the table or from the table by itself, it's not really clear what the salvage value is, right? Because the salvage value is just whatever is in excess of the regular income, which is 17,480, right? And so I kind of wrote it down and kind of just kind of from the beginning, just so that you can kind of see is that in order to get the salvage value, you can subtract whatever value that you got at the end minus the regular income. Okay. Our question. So is it kind of like a salvage value after taxes? So the salvage value is just the same salvage value that we've been working with before. Oh, you mean the difference here? Yeah. And so this difference here is the salvage value after taxes, right? Because that $10,000 that you're going to get from selling the truck, that counts as like regular income. And so just like you make money from other ways, you're going to get taxed on that as well. Mm-hmm. All right, any other questions on this before we move on? Okay. All right, and so from this example, you can see that taxes actually make a really big difference, right? And so our present worth value actually reduced by 10,000. Okay. Okay. And so we've been ignoring it up to this point, but it's not good to ignore anymore. Right? And so now that we know how to incorporate it, it'll make our economic analyses a lot more accurate. Okay. Okay, and so at this point, now that we see how much of an impact these have, I think a fair question to ask is what types of assets or what types of equipments are subject for depreciation. Okay. Right. And so I'd say there are three characteristics of an asset that can be depreciated. Okay. All right, and so let's go over each of the three. And so number one, and so the first characteristic a depreciable asset needs to have is that it needs to be used for business purposes to produce income. Okay. Right, and so any personal equipment here doesn't count, right? And so you can't buy a Lamborghini and then say that, oh, I use this for my business. They're probably going to deny that from you. Okay. But with nowadays, the line is getting blurred quite a bit because there's a lot more people working remotely, working from home. And so, in those cases, people use their personal computers or they use their personal cell phones to conduct business. Okay. I know I did over the pandemic. And so basically all the work that I did over the past year and a half at home was on just my personal laptop. And so, the line is definitely blurring a little bit, as the devices kind of get used for kind of more than one thing. Okay. All right. And so number two, the number two characteristic is that the asset must have a useful life that can be reasonably determined. Okay. And then in order for it to be eligible for depreciation, this useful life has to be greater than 1 year. Okay. Number three. And so the number three characteristic is that the property has to be an asset that either decays, it gets used up, or wears out, becomes obsolete, or otherwise loses value with time. Okay. All right, and because that's the whole point of depreciation, right? And so depreciation is just a representation of how certain assets lose value over time. Okay, and the amount that the asset loses value, that's how much you can deduct from taxes. Okay. All right, and so with these three aspects in mind, I have a little bit of a brain twister for you, and this is and I did ask this question on the homework, and so I just want you guys to think about it. Okay. And so with these three characteristics in mind, I want you to think about, does land count as a depreciable resource? Okay. Okay. Think about, land, right? And so land is something that you can, you can build a business on. You can, you can definitely run a business on it. Okay. But think about whether it should count as a depreciable asset or not. Yeah. Yeah. So there's some thoughts in the chat already, but think about it and then answer it on the homework. Yeah. All right. Oh, and I forgot to mention at the beginning. So I did post the next homework. That's homework 4. And I think I gave you, I think there's about, you guys have about 2 weeks to do it, because I think it has to do with rate of return. It has to do with benefit cost ratio, and it has to do with taxes. And so it's a fairly beefy homework assignment. And so I gave you guys quite a bit of time to do it, but yeah, make sure you get started on it sooner rather than later. Yeah. A lot of good thoughts in the chat right now. Okay, any questions on this? Okay, all right, and so let's move on to the next type of depreciation. Okay, and so I'm skipping over something in the notes, but I think I want to go over some of the other types of depreciation before we end for today. Okay. Okay, and so the next type of depreciation that we'll go over is called declining balance depreciation. All right. And so declining balance is a different type of depreciation scheme that you can use. Okay, and so it's in it's an alternative to declining balance. Okay, or straight line depreciation. Sorry. Okay, and so the idea with declining balance depreciation is that the asset depreciates by a certain percentage each period. Okay. Okay. All right, and so the percentage or the depreciation amount that's that gets deducted can be computed from the following formula. Okay. All right, and so I'll give this a symbol D sub T, and so the D sub T stands for the depreciation amount for this period. Okay, it can be computed as 2 divided by n. Okay, where n again is the number of periods. Okay. And then you're going to multiply this by the previous book value. Okay. And so however much the asset was worth in the last period, okay, you're going to multiply that by 2 divided by n. Okay. And then that's going to be the depreciation amount. It's a D sub T. Okay. Where D sub T here just stands for depreciation amount. Yeah. Okay. Right, and so it's a little bit of a different scheme. And so instead of declining by a constant amount each period, the amount that the value declines is different on each period. Okay. Okay. And so this value of 2 here is fairly arbitrary, right? And so it doesn't have to be 2, but 2 is just kind of the standard that's used. Okay. And so depending on the tax rules that you're working with, and depending on how you want to roll this 2 here can be changed to a 1.5. It depends on how aggressively you want to depreciate, or just most of the time it depends on what the law is at the time. Okay. All right, and so with this in mind, let's go ahead and redo our previous example. But instead of straight line depreciation, we're going to use declining balance. All right, and so, just to kind of remind you, the last example, we had a truck that was that was used for a shipping company, and then that truck is going to be earning $20,000 of revenue each year. Okay. Okay, and so before we jump in, let's compute the declining balance amount. Okay. Oh, question. So before I go, can I go over the numerator of 2 again? Like it can be 1.5. Yeah, and so this value of 2 here determines how quickly or not you're going to depreciate. And so that number there is fairly arbitrary. The reason it's 2 is because for any period that's greater than 3 years or more, then this gives us a valid declining balance amount. But the 2 can be almost anything, but usually it's not anything too high, because usually it's something around 2 or 1.5. Yeah, you'll see the purpose in literally just 5 seconds, right? And so for this example here, okay, our n is equal to 5. Okay, and so if we compute our declining amount, okay, and so we compute dt. Okay, we just do 2 divided by 5. Okay, and so this gives us 40%. Okay, and so what this tells us is that each period, our book value, or the value of our asset, is going to be reduced by 20%, 40%, sorry. Okay. All right, and so on the next page, I'm going to go run through the table, and then I'll show you how this affects the tax calculations. Okay. All right, any questions on this before we continue with this example? Okay. All right, so let's go ahead and run through the table one more time, but this time with declining balance depreciation. Okay. And so just like last time, we're going to start with a column for the year. Okay. Okay. Next, we have a column for the before tax cash flow. Okay. I'm going to go ahead and fill in this this table all the way to the bottom. Okay. Okay. And so we remember we had an initial cost of $50,000, and then we earned $20,000 in revenue each year. Okay. And then in the 5th and final year, we salvaged the truck for $10,000. Okay. And then we earned that money in addition to that. Okay. All right. Right, and so the next column is going to be our depreciation. Okay, and so how much our asset's going to depreciate. Okay, and so unlike last time, we can't fill in this table all the way yet, because we need to kind of do this year by year. Okay, all right, and so we can compute the depreciation for the first year though. Okay, because remember our declining balance amount here is 40%. Okay, and so each year our book value, or the value of our asset, is going to reduce by 40%. Okay. And so in the first year, our initial value for our asset is $50,000. Okay. Okay. And so to compute the depreciation for that year, we're going to take 40% of 50,000. Okay. And so that's going to be $20,000. Right, and so with this 50,000 here, this is our initial book value. Okay, And then the 0.4 there represents how much we're declining that, value. Okay. All right. And so the next column in our table is taxable income, right? And so remember, the way we compute taxable income is we just take the difference between our before tax cash flow and our depreciation, okay? And so, luckily for us, our depreciation value is exactly the same as our revenue that year, okay? And so in that first year, we pay the amount of our income that's subject to taxes is 0, okay? And so we're just like Amazon here, right? We're just like Jeff Bezos, right? And so we pay no taxes on our income. Right? Okay. All right, and so if we have 0 taxable income, then we have to pay 0 taxes. Okay, that's pretty simple. All right, and then after that, we can compute our after-tax cash flow. Okay, and so since we paid no taxes in that first year, then our after-tax cash flow is going to be the same as before, and so it's going to be $20,000. Okay. All right, any questions on this so far? Okay. All right, and so for declining balance, we actually need an additional column on the right side, okay? Because we need to keep track of what the value of our asset is in each year, okay? And so there's going to be another column, and I can't fit it because my iPad is really tiny, okay? Okay, and that last column is going to be book value. Remember, the book value represents the current value of our asset at any given time, right? Let me draw the rows in here just so you can see, okay? All right, and so at the end of year 0, and so right after we buy it, our asset still has its full value, right? And so at the end of year 0, our asset's value is the same as our initial cost, which is 50,000, okay? After year 1, our asset here lost $20,000 worth of value, right? And so after year 1, in order to compute the book value, we take the previous book value and then we subtract the depreciation amount for that year, okay? And so in that first year, because we depreciated 20,000, then our new book value at the end of year 1 is $30,000, okay? And so that's how much our assets can be worth after that much. All right, and so now that we've computed the book value at the end of year 1, we can then move on to the next row in the table. Okay. All right, and so let's start with the depreciation amount for year 2. Okay. Okay. And so we're still doing declining balance. And so we're going to take 40%. Okay. And so we're going to do 0.4. Okay. But instead of multiplying by the initial cost, this time we're going to multiply by the previous book value. Okay. And so the previous book value in this case was 30,000. Okay. And so the depreciation amount for that year is going to be 0.4 times 30,000. Okay. And so that's going to be 12,000. Okay. All right. Okay. And so if our depreciation amount is 12,000, then our taxable income is just the difference between these, which is 8,000. Okay. 20,000 minus 12,000. And then the taxes that we pay is going to be 21% of our taxable income. And so we do 0.21 multiplied by 8,000. Okay. And so the amount of taxes that we pay in year 2 is 1,680. Okay. Okay. And so after we deduct our taxes from our income, then our after-tax cash flow for that year is 18,320. Okay. All right. And then, you know, since our value, our asset lost $12,000 worth of value, then our new book value at the end of year 2 is 30,000 minus 12,000. Okay. Our new book value after that is 18,000. Okay. All right. And so just because we're running a little bit short on time, I'm going to go ahead and fill in the rest of the table. Okay. But you can verify all these calculations yourself. Okay. And what you'll notice is that the depreciation amount each year is going down, okay, because the book value is also going down each year. Okay, and so that's year 3. Year 4, our depreciation is 4,320. Okay. Okay. And then year 4, this is 6,480. Okay. All right, and our final book value here is 3,808. Okay. All right. And so you can see that the calculations for declining balance get a little bit more complicated just because each year our book value goes down, and then we end up with numbers that are not, not very nice. Yeah. All right, question. So does the after-tax cash flow say 16,707? Yes. And so this is 16,707.20. Sorry about that. Mm-hmm. All right, and so I'll give everyone just a second to write it down. Okay. Okay. And then the last thing we'll do today is, now that we know the after-tax cash flows for this one, okay, in this column right here, we can then compute the after-tax present worth. The unfortunate thing is that, because our depreciation amount is changing each period, it's going to be a little bit messy to compute the after-tax present worth. And so what I'm going to do is I'm going to consider each of these individual, individual entries as an individual future worth. Okay. And then we're going to compute the present worth from that. Okay. Okay. Any questions before we do that calculation? Okay. All right, so let me go ahead and write down the formula or the expression for the present worth for this guy. Okay. All right, so the present worth for this is going to be, we have our initial cost, which is 50,000. Okay. And then I'm going to take all of the after-tax present worths, okay, and then take them all as individual future sums. Okay. And so first we have the $20,000 in year 1. Okay. Then we have the 18,320 in year 2. Okay. Then we have the 17,312 in year 3. Okay. Then we have the 16,707.20 in year 4. Then finally, we have the 24,244.32, okay, P over F, 10% and 5, okay. And so we plug in all of these conversion factors in from the tables, okay. And what we get is $22,792.47. And so if you compare this amount to our straight line number, this is slightly higher. And that's not by mistake. And so there's a very good reason for that. Okay. And the reason for that is that if you notice from our depreciation charges, we depreciated a lot more upfront. And so usually this is something that companies want to do, okay? And so usually the most desirable kind of depreciation schedule is one that depreciates most of the cost or more of the cost up front, okay? Because that will end up giving the company a lot more money on hand than the other ones, okay? And so we'll start on Tuesday talking about why that is. All right, any final questions before we wrap up for the week? Yes, this is just present worth. Yeah, so this is just present worth. You know, it has both the cost and the benefits. Yeah. All right, and so I realized I went over time for a little bit, and so thank you everyone for your patience. And so I hope everyone has a good weekend this weekend, right? And I will see you on Tuesday.
Thank you, Professor.
Thanks, guys.
Have a good one.
You too.
Oh, Professor,
Yeah.
sorry, I phrased my question wrong. Is this PW after tax?
Yes, this is after tax.
Yeah,
Correct.
thank you.
Yeah. Bailey, did you have any other questions? You're still writing down.
Oh no, I'm sorry.
Okay. Yeah, no problem. All right. I'll see you next week then. Have a good weekend.